I've got my stroking dog. Welcome to SeedSafe's channel. Today, we're exploring Double Trigger restricted stock units and how they're handled during an IPO. If you're holding RSUs and your company is going public, this video is for you. If you'd like to see a calculation of what we discussed today, look through our archives. We break down how tax withholding at IPO versus taxes due may be entirely different using spreadsheets as visuals. Now, let's jump into it. You gave up on me? Fine, whatever. I don't need you. First, let's define what RSUs are. Restricted stock units are company shares given to employees as part of their compensation. These shares are restricted because they vest over time or upon meeting specific conditions. Double Trigger RSUs require 2 conditions to be met before they vest. Typically, these conditions are 1, a time-based requirement, like working for the company for a certain number of years, and 2, a liquidity event, such as an IPO or an acquisition. At IPO, the Double Trigger's RSUs will usually settle within the first quarter. Some agreements allow for vesting on the initial day, while others will match the vesting period to the lockup period. Settlement, in this case, means income. Double Trigger RSUs are considered compensation income at the settlement date. And like your salary, some shares will be sold to cover withholding taxes unless you elect otherwise. Where are you going? And like your salary, some shares will be sold to cover withholding taxes unless you elect otherwise. Your company may offer you the ability to pay the taxes in cash or elect a higher withholding tax rate. However, just because you recognize income for tax purpose doesn't mean you can sell the shares on that day. What? The reason why this difference matters is because most tech companies do not allow employees to sell all of their shares on the first day of trading. Some companies will allow up to 20% of shares to be sold, while others will make the employee wait on selling shares. Your shares will be sellable within 180 days of the IPO date or after the next quarterly earnings call, depending on the timing. This is what we call the lockup period. With this delay, a mismatch occurs between when income is recognized versus when you can actually realize cash from selling the shares. Depending on how volatile the stock price is, this match can be quite upsetting. It's crucial to understand the timing and tax implications to avoid surprises. So as you approach the IPO, it's important to plan ahead. Understand the key components. What are my vesting dates, potential sale date? What tax election options do I have and when do I need to make that buy? What's my expected tax rate on the vesting income? And what are the strategies I should consider for managing my risk, such as selling some shares to cover the tax liability? So let's look at a case study on how this mismatch can really affect the outcome. Adi, an employee at a biotech startup, holds Double Trigger RSUs. Adi has been with the startup for 6 years and is fully vested in the shares from a time perspective, trigger number 1. The company files their S1 with the exchange and begins targeting a price of $45 a share on the public market. Adi's RSU grant states the shares will be considered vested on the IPO settlement date, trigger 2. The settlement date is the day of the public listing and the share price will be calculated based on the average price for that day. Let's say the expected date is January 15th. Adi expects to vest around $650,000 in RSUs value on that day. This means that he will have ordinary income of $650,000 on the IPO day that will show up on his next pay stub. Adi is a California resident, so he will have a few different required withholding taxes at the time of the IPO. 10.23% withholding tax from California, 22% withholding tax at the federal level, and since we're early on in the year, he expects withholding for Social Security and Medicare as well, so up to another 7.5% on a portion of the income. Based on these required withholdings, he expects to receive around 63% of his total RSU vesting in company shares, or around $409,500 in net value. But that's not all. Since he already makes around $270,000 in salary for the year, his taxable income will actually be around $900,000. This means, federally, his marginal tax rate is going to be 37%, which is much higher than the 22% tax withholding from a federal perspective. He may experience a similar, albeit smaller gap at the California level, and he will end up owing even more taxes on his tax return after year end. So for now, let's say he owes another 12% in taxes on his return, or around $78,000. As of IPO day, the shares are still not sellable, but he has income. So now let's say the stock price goes down to $35 a share before he can sell anything to cover the remaining taxes. Now let's say his total net value is only $318,000 in those shares. If the price does not recover, he's going to need to give up a larger chunk of his remaining shares to cover these taxes. That could leave him with only $240,000 to put toward his financial goals in the end. Think about it. He started with $650,000 in stock value. After withholdings at a price drop in the stock price, he will only take home $240,000. I know, I need some tender loving care with this as well. This is around only 37% of the total value that vested. This is why it's crucial to wait until cash is in hand before making any purchase decisions or implementing new plans for that influx of cash. But that won't happen to your company, right? That stock is just gonna hockey stick right out of here. I hope so. But if not, it's essential to work with a financial advisor or tax professional to develop a strategy tailored to your situation. They can help you navigate the complexities and ensure you're making the informed decisions here. Double Trigger RSUs can be a valuable part of your compensation, especially in the context of an IPO. Understanding how they vest and the associated tax implications is key to maximizing their benefit and relaxing. If you found this video helpful, give us a thumbs up and subscribe for more financial insights. Thank you for watching. If you have any questions or topics you'd like to see us cover, leave a comment below. And don't forget to check out our other videos. Until next time, go forth and grow your wealth.